In Lesson 7, we learned about the efficient market hypothesis. We learned that although the market price is almost surely wrong, it's also almost surely fair. It's as likely to be too high as it is to be too low. That's a recurring theme in several lectures. This lecture will continue to discuss trading and investing strategies, but please keep the key ideas about efficient markets in mind. That will help us sort out good strategies from bad ones. Remember, even if markets are seriously inefficient, then collectively we still just break even, and we do even worse after paying the transactions costs from frequent trading. Think of it this way. If you and I are the only two traders in the market, then anything you make above the market return has to come from me. You bought that underpriced security from me, so that means I sold it for less than it's worth. However much you win, I lose exactly the same amount. If my friend Bud joins the market, then you might win from Bud instead of me, but it's still true that your winnings collectively come out of the hides of the rest of the market players, so the entire market is still just even. Active traders are gambling that they'll be on the winning side. What are the odds of that happening? Mark Hulbert of the popular internet site MarketWatch reported the results of a study showing that 51 financial advisors out of over 200 beat the market in the 10-year period ending April 30th, 2012. That sounds impressive. Yet, of those 51, just 11 outperformed the overall market the next year, and some of those 11 have turned in below average performance since. Beating the market consistently is tough. Even in a fully efficient market, analysts can earn their keep, though. For example, we may not have good trading strategies to make you money, but we sure know some bad ones that'll cost you. Examples include churning or trading too much. That's just incurring transactions costs. Failing to diversify gives you extra risk with nothing in return. And you can easily give the tax man more than his due. Financial advisors are a lot like doctors in that sense. We've all had lots of medical experts give us good advice. Avoid tobacco, eat a balanced diet, get plenty of exercise. Keeping clients from making mistakes is a big part of financial advising. For example, a good financial advisor can help keep your risk levels where you want them to be. An economist friend, Al Allen, came to my office one day. He was clearly troubled. Allen was well aware that markets are pretty efficient and that trading just ran up transactions costs, but he just wasn't comfortable with his portfolio anymore. Why not? I asked. Well, he said, I started investing when I got out of school 25 years ago. I put something away every month, and now it's worth much more than I expected to have. You're making that sound like a problem, I said. Allen explained. I feel like I want to take something off the table and put it in something safer. But that doesn't make sense if I'll pay transactions costs and if prices are fair, does it? What Allen had missed was that his investing strategy was ignoring his risk tolerance. He started many years ago with maybe $1,000 in safe assets and $1,000 in stocks. When he came to me, he had about $10,000 in safe assets and many, many times that in stocks. Instead of being evenly balanced, he was way overinvested in stocks. He needed to sell some stocks and buy something safer. Allen needed to rebalance his portfolio. My friend's dilemma had nothing to do with whether or not the market is efficient, but he did need some financial advice to correct what was, for a person with his risk preferences, a bad portfolio error. Some strategies that you'll hear about from financial advisors and financial media really are good ideas, but not for the reasons people think. For example, some people advocate an investing strategy called dollar cost averaging. Dollar cost averaging is a way to guarantee that you'll buy shares at a lower average price per share than the average price over the purchase period. Sound good? Let me show you how it's done. You start by deciding how much you can invest each period. Let's say it's $100 a month. In January, you invest $100. With a share price of 20, you buy 5 shares. In February, the share price has fallen to $10 per share, so you get 10 shares for your $100. By March, the price is up to $25 per share, so you only get 4 shares. If you do the arithmetic, you'll see that the average share price over the period is $18.33, but you only paid an average of $15.79 per share. Sounds good, doesn't it? By investing the same amount every period, the math guarantees that you'll pay an average price per share that's less than the average price over the period. This makes my spider sense tingle. This is too easy, too good to be true. What's going on? If January's price is fair, and February's price is fair, and March's price is fair, then how can getting 3 fair prices turn out to be better than fair? How can it be a good deal? That can't make sense. The problem is that the average price per share purchased and the average price over the period are 2 different types of averages. The average price over the investment period is an equally weighted average. We count January the same as February and March. The average price per share purchased, though, is a share-weighted average. In our example, February's 10 shares count twice as much as January's 5 shares. Both of these averages can make sense because they're telling different stories. But it also makes sense for someone to say that his word is worth its weight in gold. That sounds wonderful too, until you think about how much his words weigh. Although I don't think dollar cost averaging delivers what it promises, I do think it has some appeal. If you dollar cost average, then you invest on a consistent, ongoing basis. That's good. Dollar cost averaging may lead to good outcomes, just not for the reason most people think. Many of you have heard purported experts saying that the market did this or that because of something called market psychology. I'm not a fan of that explanation because it doesn't teach me anything. If the market goes up and people don't know why, then they just say it was psychology. If the market goes down and they don't know why, then they say the same thing. Who needs experts like that? What's missing from the market psychology explanation is investing advice. The efficient market hypothesis teaches me to minimize transactions costs because I can't beat the market consistently. Portfolio theory, as we learned in Lecture 5, teaches me to diversify. What I need from the psychology story is some advice that I can actually use. In the last couple of decades, the field of behavioral finance has evolved to the point of being able to do that, or at least to come close to being able to do that. The idea behind behavioral finance is that people's emotions affect prices. Of course, everybody agrees that emotions do affect people's decisions. For behavioral finance to make a difference in the price of stocks, though, we also have to assume that the sharp guys, the ones who have lots of data, technology, skill, and time to spend on stock analysis, are restricted in the amount of trading they can do. The reason those restrictions matter is that if the clever traders are unfettered, then competition will protect the emotional traders. Suppose that Amazon is trading at $400 per share before a bit of bad news comes out. Now it's only worth $390 per share. Suppose I make a bad mistake, and I think it's only worth $300 instead of $390. Because of that mistake, I want to sell now as fast as I can before Amazon falls to $300. I'm so scared that I'll sell at any price I can get over $300. Now, you and Margie are clever and know better. You know Amazon is worth $390. You'd be happy to buy at $300 from a sucker like me. My broker has the obligation to get me the best price, though. He's going to check Margie's bid, your bid, and everyone else's bid. In a competitive market with enough clever traders, I'm going to get right around $390 for my shares, whether I panic or not. If there are enough clever investors competing, then the price will be fair, even with a bunch of panicked investors. That's why behavioral finance needs to limit the amount of trading that these clever people can do. Otherwise, their theory breaks down because emotional traders don't make any difference to prices. I'm not sure I buy the behavioral finance story. I think that behavior finance can help us the most by identifying the emotional pattern behind the temptation to make mistakes. Have you noticed that you put more weight on the opinions of those who agree with you? That would be an example of what's known as confirmation bias. We tend to find evidence that supports the things we already believe. Do you find yourself reading articles and watching shows that agree with your political opinions and skipping those that disagree? I'll bet that you do. We tend to interpret "he agrees with me" to mean he's a smart guy, don't we? Lots of investors succumb to this. They have an opinion of a stock, then they find a bunch of stock research that supports their opinion. The portfolio advice from this insight is that you're going to be tempted to stick with a mistake too long. If you think financial advisors can pick winners for you, then you're more likely to accept arguments that explain any poor performance he might produce. Instead of waiting until several years of bad performance have already occurred to decide whether to find a new advisor, decide what your trigger point is ahead of time. Maybe you'll tolerate 1 year of being 10% below the market, but not 2. Whatever it is, decide. If you hit your trigger point, then follow through with your decision and replace your advisor. If you wait to decide until after a string of bad years, then you're more likely to be persuaded by excuses that fit with your bias. Most people are prone to being overconfident. This fits with the old adage, "A little knowledge is a dangerous thing." Overconfidence bias boils down to thinking that you have a skill or advantage that other people don't have. A person with a pilot's license might rightfully believe that he knows more about airlines than other people, but that doesn't mean he can invest in the airline sector with more success. The biggest danger from overconfidence bias is probably that it convinces you to trade more. That's more likely to run up transactions costs than anything else. At some point of your career, you'll own a stock that's been a disaster. You can't even think of it without feeling sick. Loss aversion bias makes it hard to admit that the loss is real, and you hang on to the stock telling yourself, "I just want to get my money back." That's loss aversion bias at work, tempting you to make a mistake. You'd be better off selling that loser. We'll see in Lecture 14 that the Internal Revenue Service gives you a big incentive to sell. If you don't, then you're passing up a nice tax deduction. As you journey through your investing career, see if you can catch yourself gathering information that agrees with you, feeling overconfident, or being unable to admit a mistake or to accept a bad outcome. I'll bet it happens a lot more than once. You know by now that I think the stock market is pretty darn efficient. Not perfectly efficient, but close enough for people like us to treat it as efficient. That said, there are a few intriguing observations we can make that can help us invest more wisely, perhaps. First, 2 sets of market experts, Professors Andrew Lowe and Craig McKinley, as well as Professors Jennifer Conrad and Gautam Kaul, found that over short horizons, maybe a few weeks, stock market trends tend to persist. Good weeks tend to be followed by good weeks, and bad weeks tend to be followed by bad ones. Weekly stock returns seem to have a little momentum with emphasis on the word little. Later, Professors Narasimhan Jagadish and Sheridan Titman demonstrated that portfolios of stocks that did well over a period of a few months to a year tended to do well over the next period too. This effect was big enough to let you make a little money, at least at the time of the study. Before you run off to implement this trading strategy, though, you need to know that any short or intermediate term momentum typically reverses over longer periods of about 3 years. Professor Werner DeBont of the University of Wisconsin and Richard Thaler of Cornell University conducted the study that's easiest for me to remember. You buy the 35 stocks that stunk it up the most over the last 5 years. Sell the 35 stocks that did the best over the last 5 years. Then hold that position for 3 years. DeBont and Thaler found that on average, the losers beat the winners by a total of about 25% over those 3 years. Think of this as a long-term reversal effect. If you decide that you want to chase a little bit of extra return by playing short-term momentum and long-term reversal, realize you have to make a rather dicey call on what's short-term and what's long-term. You might be able to make a little extra money relative to the market by playing this game with small, illiquid stocks. Small and illiquid stocks show this pattern more reliably than the rest of the market. These stocks are more expensive to trade, though, so it's not too surprising that many apparent profit opportunities that exist before trading costs aren't profitable once we factor in those costs. Another strategy that might earn a bit more than the market average is to buy what traders call value stocks. These are stocks with low market values compared to their accounting book values. Some studies have shown that these stocks tend to do a bit better than traditional risk measures predict. Yet another idea is to buy the stocks of companies that repurchase their own shares as soon as you learn that they plan to do it. There's some evidence that share repurchases foretell above-average returns. Buying stocks with low betas seems to be a reasonable plan too. Beta is a technical measure of how a company's stock price moves relative to the market. High beta stocks tend to move more than the market. Low beta stocks tend to move less. The average stock, by definition, has a beta of 1. The strategy of buying low beta stocks isn't designed to earn big returns. It's designed to earn bigger returns than you probably ought to earn given the low levels of risk you take. You can get estimates of stock betas from Value Line or Yahoo Finance or any of several other places. Warning, these estimates are notoriously inconsistent and unstable. That's both because there's no best way to estimate beta and also because there's some evidence that a stock's beta really does change over time. Following these strategies appears to produce returns that are slightly above what you might expect for the risks you take, or at least for the risks as we traditionally define them. Funny things tend to happen, though. Professor John Cochran of the University of Chicago gives the example of value stocks, the ones with low market values compared to their accounting book values. You might think that you can add a lot of different value stocks to your portfolio and diversify the risk, but it turns out that value stocks tend to rise and fall together. You just can't get diversified if you hold a lot of value stocks. There's something about value stocks that gives them a tendency to move together. I think that's the reason for this. It's a risk factor that we don't understand yet. If value stocks carry more risk than traditional measures suggest, then it makes sense that you'd have higher expected returns than traditional measures suggest too. Professor Cochran warns against chasing abnormal returns, at least not as your main portfolio goal. Instead, he recommends tailoring your portfolio so that it won't crater at the same time you lose your job, for example, or your business fails. That's exactly when you're going to need the money from your investments. If you work for Ford, then don't buy a lot of auto stocks. I'll leave you with one more thought before we switch topics. If you think you can improve your portfolio returns by shrewd trading, remember Lecture 6 and give some thought to how much you'll earn in dollars. Suppose that you spend an hour a day, just on weekdays, studying stocks. You build your trading strategy on what you learn. Suppose that you turn out to be a great trader. You beat the market by 5% a year, year after year. That would be incredible. Don't race to buy a private jet, though. If you invest $100,000, then you would make an extra $5,000 a year by investing those 260 hours, or a bit less than $20 an hour. That's nice, but don't quit your day job. This is a course in how the stock market works, not how to trade options. You can look at options as a way to buy stock, though, so let's see what we can learn. First, what is an option? When your daughter Tiffany was wondering how she could handle the big yard in that house she was thinking about buying, you told her she had several options. She could mow it herself, pay a neighbor's kid, or hire a professional lawn care service, for example. Your daughter could pick one of these or not. Nobody could make her do it, but she could if she wanted. She had the option. Options on stock come in two basic types: call options and put options. Owning a call option gives you the ability to buy shares at a predetermined price if you want, but you don't have to do it. A put option is the reverse. It gives you the ability to sell shares at a predetermined price if you want, but again, you don't have to do it. Options come in so many varieties it'll make your head spin. We'll focus exclusively on simple call options. That's because all we need for this course is an overview of what an option is and the factors that affect its value. Most people think that's easier to do with calls than puts. You're more likely to encounter call options, too. You buy or sell an option through an options exchange, such as the CBOE, short for Chicago Board Options Exchange. Your broker will have access to one. Subject to SEC rules, the option exchange has complete discretion to set the terms of the contract. These terms affect the option's value. For example, the predetermined price you'll pay if you decide to exercise your option and buy the stock is obviously important. An option that lets you buy at $1 million per share isn't worth much because you'll always be able to buy the shares for less than that on the open market. The exercise price, also known as the strike price, is too high in this case. Who needs an option like that? The lifespan or maturity of the option makes a difference in its value too. The longer the life of the option, the more valuable it is. That makes sense too. If the stock is trading at 50 and the strike price is 60, then the option is out of the money, meaning that if you exercise it, you'll lose. If the option is only good until tomorrow, then the odds are that the stock won't reach $60 before the option expires. If you have 90 days before expiration, though, then there's a chance that the stock will rise above the strike price and be in the money. If it does, then you can exercise your option to buy the stock at the strike price and make a profit. Options traders know that other factors affect the value of an option besides these things. The most important are the interest rate and the volatility of the stock. We don't need to learn those details for this course, but don't think that options pricing is easy. In fact, it's frightfully difficult. When I work with options, I prefer to think in terms of payoff diagrams. Let's say that we buy an option on Hershey's, the candy company, which expires in 60 days. Let's say that the strike price is $100 and the option costs $10. Now imagine a graph and label the horizontal axis as the share price. Label the vertical axis as our profit or loss. If Hershey's doesn't rise above the strike price of $100, then the option is worthless and will have lost $10. So our payoff can be represented by a horizontal line at negative $10 from 0 through 100 on the horizontal axis. We'll wish we hadn't bought that stupid option in the first place. Beginning at a price of $100 for Hershey's stock, though, good things start to happen. At a price of $101, we make $1 by exercising. That doesn't cover the option's price, but it holds our loss to $9 instead of $10. Our profit line is still in negative territory, but it's tipped up $1. For every dollar above $100 that Hershey's stock costs, we make $1 on our option, so the line keeps moving diagonally upward and to the right. That's because our option still lets us buy the stock for $100. If Hershey's is at 110, then we recover the $10 cost of the option. If the stock price is higher than $110, then we make a profit on the option purchase. The payoff line then is shaped like a hockey stick. It's flat at negative $10 until the share price reaches the strike price. Then it increases dollar for dollar with the stock price. Our profits from buying the option are limited only by how high the share price can go. When would you use a call option? First, you might be willing to take a chance on a stock. If you were confident that Hershey stock would appreciate over the next 90 days, then you could buy call options on Hershey shares instead of buying the shares themselves. Why would you do this? Because you can act on your confidence in Hershey's with a much lower investment. In our example, Hershey's was trading at $100, and if you wanted to buy shares directly, then that's what they'd cost. Options that are at the money or a bit out of the money would probably cost just a couple of dollars. If you're wrong and the stock stays close to the strike price or declines, then you're out the cost of the options plus trading costs. But if you're right and those options end up in the money, then you're going to make about as much on each option as you would if you had bought the share itself, and with just a fraction of the initial investment. You don't pay the strike price unless and until you have a profit. We've covered a lot of ground about investing strategies, and you might be thinking, I still feel overwhelmed. How can I be a better informed investor? Many financial advisors will tell you to read a lot, watch the business news, and pay attention to what the stock market is doing. My advice is to ask a different question. You don't really want to be a better informed investor. You want to be a better investor, period. People say that Abraham Lincoln read a lot. Many historians think that's not quite accurate. Honest Abe did read, yes, but what set him apart was that he thought a lot about what he read. So sure, read and watch the business news, but think about what you read and hear. If a company has strong earnings, then that's good for the company, yes. But does it make that company a good investment, or has the price already risen so that it's too late to cash in? Remember the guys with computers who trade in microseconds? By the time you learn about those strong earnings, it's too late to trade at the old price. Or, if you read that the market has been volatile lately, with prices bouncing up and down a couple of percent almost every day, then what should you do? If the market is volatile, then you're taking more risk than you normally do. Maybe you ought to invest in safer assets for a couple of months to compensate. Regardless, recognize that you'll never know enough. Investing is a gigantic field, and anyone who pretends to know even most of it is trying to fool you, and perhaps himself too. If you're like me, that is, if you're old, then you get bombarded with offers to attend a free dinner with a couple of dozen other people. Your host will be an investment advisor, and before dinner, he'll give you his roadshow. Come to think of it, there's no free dinner either, is there? I admit to being a finance geek, but I just love these. As I watch the presentations, I keep asking myself questions and thinking through the answers. One advisor had a graph of his portfolio performance over the last 18 years. He'd never once had a down year. It turned out that he was hedging with options, and he didn't include the cost of the options when he calculated his portfolio return. When the market went down, his stock portfolio was hedged, but he lost on the options. The cost of those options wasn't in the graph on the portfolio, though, so it looked as if he never lost any money. You will become a better investor if you think like that. Use your knowledge of how markets work to try to understand what's actually going on. Think about when a particular strategy wins and when it loses. In our next lesson, we'll sift through the esoteric world of financial statements. Our goal won't be to become experts in financial accounting, of course. That would take years. Instead, we'll be focusing on a few key concepts so that we can understand the language financial accountants use. That's much less painful.